They told you the market was supply and demand. They never mentioned the supply could be fabricated. In January 2021, a glitch appeared in plain sight. GameStop surged, but something else rose with it, a number no one could explain. There were only 50 million shares available, but over 150 million trades every single day. How is that possible? Because not every share is real. Some are manufactured, not by companies, but by contracts, wrapped in legal language, hidden in digital shadows. You thought you were buying a piece of a company, but what if you were buying exposure to nothing? This isn't a bug in the system. This is the system. And what you're about to see was never meant to be seen. It began with a contradiction. Brokers were executing trades far beyond the number of shares actually in existence. GameStop was just the beginning. AMC, Metamaterials, Bed Bath & Beyond. In case after case, trading volume exploded past logic. 50 million shares in float, but trades surging into the hundreds of millions. Not once, not briefly, but repeatedly, across days, weeks, entire market cycles. The official narrative? High demand, volatile market. But behind closed doors, some traders were whispering another explanation. A quieter one, a more dangerous one. Synthetic shares. Shares that weren't issued by the company, weren't registered, didn't exist on any official ledger, but still moved as if they were real. Because in the modern financial system, reality is negotiable. And yet, they moved prices. They generated profits. They flooded order books, filled portfolios, triggered algorithms, and warped the very signals investors rely on. You weren't buying stock. You were buying pressure. A digital ghost that mirrored real shares but lived entirely outside the company's books. A shadow with weight. And the most unsettling part? It was legal. This isn't about counterfeit shares. This isn't about some rogue actor breaking the rules. This is about how the rules themselves were written to allow it. Synthetic positions can be created without limit, without registration, without disclosure. They're engineered into the structure of modern finance. Options, derivatives, swaps, contracts for differences. What they have in common is this: exposure without ownership. In this mirror market, price action can occur without real supply. Volume can surge without a single certificate changing hands. All it takes is a trader on one end and someone willing to bet on the other. The underlying asset? Optional. During the GameStop saga, as retail investors poured into call options, market makers were forced to hedge. That meant buying real shares to offset synthetic risk, creating a positive feedback loop. A short squeeze, a historic event. But hidden behind that chaos was a revelation few understood. The very structure of synthetic exposure had overwhelmed the real supply. The number of implied shares circulating was greater than the float, and not by accident, by design. The implications are enormous. Real dollars change hands, real companies see distorted valuations, and the average investor, thinking they're getting in early, is often entering a game already rigged by invisible players. A simulation of a market. A system where the supply of shares is unknowable, where buying pressure doesn't always reflect demand, where the market's price signals have been replaced by synthetic noise. In 2021, FINRA quietly issued warnings, failures to deliver, unsettled trades, excessive short interest. But none of this stopped the machine. Because nothing was broken, it was working exactly as intended. The system doesn't require actual ownership anymore. It only requires the illusion of it. If a hedge fund can simulate holding 10 million shares through a swap without appearing on any shareholder list, without triggering a single disclosure, then what does ownership mean? If shares can be multiplied by contracts and exposure can be stacked without limit, who controls the price? And if ownership can be endlessly simulated, can power be endlessly hidden? Maybe this wasn't about GameStop at all. Maybe that was just the moment retail glimpsed the source code. But if that was only the surface, what's buried underneath? And who's building it?
To understand what's buried beneath the surface, you have to follow the tools that built it. Synthetic shares don't appear out of nowhere. They're not typed into existence by a rogue trader in a dark corner of Wall Street. They're engineered, legally, methodically, using instruments that were never designed to be seen by the public. And the most powerful among them are derivatives. Derivatives aren't side bets. In the modern market, they are the main game. They allow vast exposure with minimal capital. They unlock profit in places where no transaction ever occurred. But more than that, they allow traders to simulate ownership without ever touching a single share. Start with options. A synthetic long position can be created by buying a call and selling a put at the same strike and expiration. On paper, there's no stock involved, but functionally, it behaves like one. Identical risk, identical reward, identical movement. It's exposure wearing the costume of ownership. And when exposure is indistinguishable from the real thing, price reacts. That's when phantom liquidity takes over. Not real demand, not actual investors, but synthetic flows. These flows trigger hedges, which trigger buying, which trigger algorithms. It's movement built on movement, no fundamentals required. Next, CFDs, contracts for difference. Popular in Europe and Asia, they let traders bet on price without ever owning the asset. You don't vote, you don't hold, but you profit or lose as if you did. Multiply that across tens of thousands of accounts, and you create a wave of synthetic demand, a price force with no substance beneath it. And then come the swaps. Total return swaps let institutions receive the gains and losses of a stock without ever appearing on a shareholder list. No public record, no transparency, no trigger to alert the market. It was this exact tool that Archegos Capital used to build a multi-billion-dollar empire hidden in plain sight. They didn't own the shares, but through swaps, they controlled them, until the illusion collapsed. When one counterparty flinched, it unraveled. Within days, $20 billion vanished, not because a company failed, but because synthetic exposure reached a scale the market couldn't absorb. That's the risk. These instruments don't just simulate shares, they stack on top of each other. Options on swaps, swaps on ETFs, CFDs on indexes already inflated by synthetic inflows. Layers upon layers, none of it anchored in the real float. And with every new layer, the system becomes more fragile. Because every synthetic share created adds pressure, pressure that eventually must be absorbed by the real thing. Market makers hedge, brokers scramble, prices distort. But here's what most don't see. The entire chain depends on trust. Not trust in the companies, trust in the counterparties, Trust that exposure will be settled, that losses will be covered, that the illusion will hold long enough to exit. What happens when it doesn't? What happens when multiple synthetic claims chase the same real asset and only one of them can be honored? We've seen glimpses, flash crashes, margin spirals, sudden liquidity black holes. But those were just sparks. The fuel is still out there, layered in options books, buried in swap contracts, ticking inside leveraged CFDs. Layers upon layers, none of it anchored in the real float. And the system that allows all of this to exist doesn't just tolerate simulation, it rewards it. Because in this market, you don't need to own. You only need to look like you do. But if price is being shaped by positions no one sees, if ownership is being replaced by exposure, then who's really steering the market? And more importantly, what happens when the illusion becomes too big to unwind?
If derivatives are the tools, what are they building? Not just exposure, not just synthetic trades, but a new class of profits, the kind made without ever touching the asset. In the old market, ownership was everything. It gave you control, dividends, a seat at the table. But in today's market, the biggest players don't want ownership. They want access, influence, leverage, and above all, invisibility. Take phantom stock. It sounds like fiction, but it's one of the most common compensation tools in corporate America. Instead of giving executives actual shares, companies grant synthetic equivalents, rights to the value of shares, not the shares themselves. No dilution, no voting rights, no SEC filings, just the upside. When the stock rises, they get paid. When it falls, they don't. But none of it touches the public float. It's all off the books, and it's everywhere. Facebook, Amazon, Google, hidden in the footnotes of financial reports, entire fortunes built on synthetic equity. Then there are the funds. Hedge funds use total return swaps and options overlays not just to gain exposure, but to hide it. They can replicate a $500 million position without appearing on any shareholder registry. The result? They move markets without being seen, trigger trends, control narratives, and when the time comes to exit, they leave no fingerprints. This isn't theory. In 2021, a major fund built synthetic exposure to a biotech firm. When it collapsed, retail was left holding the bag. The fund? Already gone. Profits extracted. Risk transferred. This is the architecture of profit without presence. Because if you can simulate a position, extract the gains, and exit before the cost is due, why would you ever want to hold the real thing? That's the logic. Ownership means responsibility, disclosure, regulation. Exposure means control, without the strings. And this isn't limited to hedge funds or tech giants. Even pension funds are entering swap agreements. Even retail brokers offer CFD interfaces. The game has scaled. The more we disconnect from real assets, the more powerful synthetic ones grow. It's faster, it's cheaper, and above all, it's silent. But silence isn't safety, because while synthetic profits stack invisibly, so does synthetic risk. The deeper we dig, the more we see value is no longer tied to ownership. It's tied to belief. Belief that someone else will honor the contract, that liquidity will be there, that exposure will pay. But what if they don't? What happens when a market built on simulations suddenly demands something real? Because as the synthetic grows, so does the distance between perception and price. And the next time something cracks, who will know where the exposure is hiding? If you're still with us, if you're beginning to see how deep this goes, this story is just getting started. You might want to like the video now. It tells the algorithm you're ready for the next layer. And what comes next changes everything. It's easy to think this is all new. Options, swaps, synthetic equity, a modern invention for a digital market. But it's not new. It's a pattern, and we've seen how it ends. In 2008, the market collapsed under the weight of synthetic instruments. The headline said mortgage crisis, but what failed wasn't housing, it was belief. Banks weren't just selling mortgage-backed securities, they were stacking derivatives on top of them, layers of exposure with no real asset underneath. Securities based on debt, repackaged into other securities, insured with instruments that only paid out if the world ended. They called them synthetic CDOs. On paper, they multiplied the value of every mortgage. In reality, they multiplied the risk until no one could tell what was real and what was engineered. At the time, these tools were praised for risk distribution. They didn't distribute risk, they buried it. And when the music stopped, the entire system fell with it. Now, it's happening again. But this time, it's not mortgages, it's equity. A share used to represent ownership, a claim on a business, a seat at the table, a slice of something real. Today, that share can be simulated through options, CFDs, swaps, synthetic plans, until the number of claims on it far exceeds the actual float. And the market allows it because it was designed to. When too many synthetic positions chase the same float, a fracture becomes inevitable. You can't have infinite leverage on finite assets forever. It starts subtly, a spike in volatility, a hedge that fails, a margin call triggered by phantom exposure. And then it spreads, because in a synthetic system, risk isn't isolated, it's chained, amplified, hidden until it explodes. One fund's loss becomes another's liquidity crisis. One missed settlement becomes a counterparty panic. One invisible position becomes a visible collapse. And what makes it worse is that no one knows how big the network is, because no one tracks the whole web. Most of these contracts are private, OTC, off-book, off-grid. The illusion of control persists until it doesn't. When trades stop clearing, when brokers freeze withdrawals, when price no longer reacts to news but to fear. Not a crash, a seizure. And this time, it won't just be banks. Because today, synthetic exposure isn't limited to Wall Street. Retail brokers offer fractional CFDs. Pension funds hold swap-laced ETFs. Corporations issue phantom shares. Even regulators are exposed, by design or by blindness. When Archegos collapsed, banks lost billions in days. Not because the stocks failed, but because the synthetic structure was built so tall no one saw its shadow. Now imagine that same logic operating at global scale. Multiple Archegos-level structures cross-collateralized, swap-fed, and algorithmically synchronized. A collapse loop isn't a single event, it's a delayed detonation, built over time, hidden by profit, and triggered by something no one expects or admits. That's the final irony, because the next shock to the system won't come from something real. It'll come from a question. Who actually owns what? And when the system hesitates to answer, even for a second, liquidity disappears, trust evaporates, everyone runs for the exit. But the exits were never designed for everyone to leave at once. So look closely, because the danger isn't in what you see, it's in what you thought was real until it wasn't. And if the market is pricing simulations, what's the value of reality? You were told the market was built on fundamentals, earnings, supply, demand, real companies, real value. But behind the tickers and terminals, a different machine has taken over. A system where ownership is simulated, where prices are shaped by contracts, not conviction, where belief is the last collateral. And maybe that's the truth no one wants to say out loud. The market still works, it just doesn't work how you think. Because you're not trading shares, you're trading shadows. And sometimes, shadows collapse. The next crisis won't be a crash, it'll be a correction of perception, a reckoning between what exists and what's been endlessly multiplied. And when that moment comes, when illusion and reality finally diverge, the ones who saw it first won't be the ones shouting. They'll be the ones watching silently, because they've seen it before, and they'll see it again. If this story opened your eyes, share it. If you want to see deeper, subscribe. And if you're still here, you already know. Some truths aren't meant to be shouted. They're meant to be found.